Learning objectives. By the end of this module, students will understand basic option terminology, calls, puts, strike price, expiration. Learn how covered calls generate income. Understand when covered calls are profitable or risky. Be prepared to sell their first covered call on SPY once they own 100 shares. Section 3.1. What is an option? Key concepts. An option is a contract that gives the buyer the right, but not the obligation, to buy/sell an asset at a specific price before a certain date. Options are derivatives, they derive value from the underlying asset, for example, SPY. Term definition: call option, right to buy at a specific price; put option, right to sell at a specific price; strike price, the agreed upon price in the contract; expiration, the date when the contract ends; premium, the price paid or received for the option; contract size, one contract equals 100 shares. In this course, we focus only on selling covered calls. Section 3.2. What is a covered call? Definition: a covered call is when you own at least 100 shares of a stock or ETF, for example, SPY, and sell a call option against those shares, agreeing to sell them at a higher price in exchange for a premium. You get paid up front, whether the call gets exercised or not. Section 3.3. How covered calls generate income. Real example: you own 100 SPY shares at $500. You sell a 45-day call with a $520 strike for $2.50. You immediately collect $250 in premium. Two outcomes: SPY stays below $520, keep shares plus $250. SPY goes above $520, your shares are called away, but you profit $2,000 from capital gains, $520, $500, $250 premium. Total gain equals $2,250. Repetition equals income. Strategy: covered calls can be sold again and again every month or 45 days. Premiums vary with volatility, time, and strike price. Section 3.4. Risks and trade-offs. Risk explanation: assignment risk. If SPY closes above your strike at expiration, you're forced to sell your shares. Opportunity cost: if SPY rallies hard, your upside is capped. Downside exposure: covered calls don't protect you from losses in SPY, you still own the shares. Call too close to money increases chance of assignment too soon. Covered calls work best in flat or slow rising markets. Section 3.5. Key terms refresher. Term definition: ITM, in the money, strike current price. Theta, time decay, works in your favor as a seller. Delta, approximately probability the option will be in the money at expiration. We will focus on selling OTM calls with 15 to 30 delta, conservative but profitable. Hammer and wrench emoji. Section 3.6. Tools to use option chain viewers, your broker platform, tastytrade, Schwab, Thinkorswim, etc. Yahoo Finance Options Strat for strategy visualization. Calculators, SIBO Options Calculator. Options Strat profit/loss diagrams. Watch lists, monitor SPY price and implied volatility. For Section 3.7. Lesson summary. Concept takeaway. What is an option? A contract with rights to buy/sell an asset at a set price. What is a covered call? Selling a call against shares you already own. Goal: generate regular income on long-term SPY holdings, best for sideways or slightly bullish markets. Section 3.8. Assignment: simulate your first covered call. Instructions: go to Yahoo Finance. Find the next 45-day expiration. Choose a strike 5% OTM, for example, if SPY equals $500, strike equals $525. Note the premium offered. Use an options calculator to estimate potential return. Deliverable: submit a screenshot of the option chain plus expected return on assignment or no assignment. Section 3.9. Quiz. Optional question 1. What is a covered call? A. Buying a put and call together. B. Selling a call on shares you own, white tick mark emoji. C. Selling a call without owning shares. D. Buying a call on margin. Question 2. If you sell a call and SPY closes above your strike price, what happens? A. You lose the premium. B. You buy more spice. C. You are assigned and your shares are sold. White tick mark emoji. D. Nothing. Thanks for watching. For similar content, please like, share and subscribe. See you in the next module.